Hi, we're here with Carl Tannenbaum, Chief Economist of Northern Trust. Carl, great to see you.
Good to be with you.
So, 10 years ago, the housing sector was at the center of the financial crisis. What has changed since then to prevent a recurrence?
The lessons learned from the financial crisis centered largely on housing and the way it's financed. Underwriting standards for people looking for mortgages were reinforced. You now have to come in with a much larger down payment than you did, let's say, in 2007. And the ability to qualify for a loan based on your income is harder than it used to be. In addition, we took steps to make sure that the securities that are backed by home mortgages, which were part of the agents of contagion, the weapons of mass destruction they were called in some cases during the crisis, we made that market much safer, but that also meant that there were fewer of them issued and fewer loans made as a result of them. Since the financial crisis, home ownership in the United States has gone from 69% of the population to 65%, and that is a retreat that has certainly affected millions of Americans.
How is the housing industry doing now? Has it regained its footing?
It's progressed, but slowly. Relative to other parts of the economy, actually residential housing has lagged since 2009. Home sales are nowhere near their record levels of 2007, and home construction has also proceeded very, very slowly. And while house prices in some markets that we like to talk about, like Silicon Valley or Washington, D.C., have escalated quickly, house prices overall in the country have not gone up that rapidly. So it's been a modest recovery at best.
At a time when the overall economy is clipping along nicely, what's holding housing back?
The proximate causes are really three. First of all, interest rates have been rising. The cost of a 30-year mortgage is about 100 basis points or 1% higher than it was 12 months ago. Number two is the fact that the tax reform that was enacted last December limited the deductibility of interest on mortgages and also property taxes for homeowners in a number of states. And we are seeing those states have slower housing activity than other states. And finally, new prospective homeowners have a lot of student debt, and that has deferred their ability to even think about buying a home. And so those three factors are combining to really limit the progress of the American housing industry.
Do any policy changes come to mind that would help the situation?
Well, there's some that come to mind, but I'll sound harsh and say that we shouldn't embrace any of them. Housing had gotten well out over its skis in 2007, and nobody wants to go back to an environment like that. We may have pushed too many people too quickly into too many homes that they weren't able in the long run to afford. And so what we have is maybe a slightly smaller housing industry, or more correctly, one that's growing less rapidly, but one that's a lot more stable and less likely to create the kind of infarction that we had 10 years ago.
Carl, thanks for your perspective as always.
My pleasure.